Welcome to Barchart series of educational webinars designed to enlighten you on a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer some traders' insight to help you make a more informed investment decision. Today's subject, portfolio risk management, tools of the trade. Investing is a multi-step process that starts with stock selection and it ends with closing of a position. Now, each step has a distinct criteria or process or procedures. And in today's special guest webinar, we're going to explore how to assess risk in our investment portfolio, determine when it's the right time to walk away from an investment, be it by its standalone performance, either by price or alpha, how it compares to the major indexes, or has it reached a risk threshold based on the individual's risk tolerance. Now, to help me with this discussion, I've invited an investment veteran of 5 decades to share his secrets and tools of the trade. And along with, not yet, Jim, along with how Barchart makes his assessment that much more easier. Anyways, hello everyone. My name is John Rowland, Barchart's senior market strategist. And as I mentioned in the opening monologue, I'm honored to be joined by a seasoned veteran of portfolio management, Jim Van Meerten. And as I must confess, I do employ some of Jim's techniques in my own process. So stick around as we will explore the world of portfolio risk management. And before we get started, please welcome our moderator and Barchart's project manager, Jean Baker. Hello, Jean.
Hi, John. Hi, Jim. Glad to be here with both of you today. It's going to be an exciting
I'm glad
webinar.
you're here. I know you've been busier than a one-armed paper hanger with the rollout of our new charts. So hopefully we'll get a chance to highlight some of those today as well.
That sounds good.
I just want to remind folks that, here we go, remind folks today that decisions buy, sell, or hold are best made by with guidance with a financial advisor, and that, I will also add that it's important when it comes to investing that you do have some type of financial plan in terms of how you want to invest. I'm sure Jim's going to point that out as well. And then under no circumstances shall we be liable for any losses or damages that you occur as a result of trading or investment activity that you or anyone else engages in based on the material or information that you receive through Barchart and our services. Okay, so my special guest has been actively trading and investing since the 1970s, and during his professional career, he's been an accountant, an attorney, a professional financial advisor, and a compliance officer. And he's a daily contributor to Barchart's Chart of the Day, which discovers outperforming stocks using the features and tools found in Barchart. I'm honored to call Jim a friend and a mentor. So please welcome Jim Van Meerten. There you are, buddy.
Good morning. How are you doing?
How's it going? All right. Well, first of all, welcome and thank you for being here. And I know you're going to share a lot of your wealth of knowledge today, so I want to thank you for that as well.
All right, you're ready for me to begin?
Yeah, so Jim, in a nutshell, let's kind of just break this down. What are the attributes of successful investing?
Well, successful investing, as you said in your introduction, basically has two parts. The first is the stock selection, And then the second is monitoring your positions and deciding when you're going to get out of them. Now, we're going to be using several tools today. We're not going to go into discussing how to customize these for yourself. At the end of our seminar, John, you'll be putting up some links for people to go find out how to do their own custom views, their own charts, and that stuff we've covered in other seminars and webinars. But today we're going to be looking at custom views, custom charts, bar chart opinions, and the stock trading strategies that Barchart has. Now, what we're really doing is looking at, I like to use an analogy of Kenny Rogers' gambler. And basically, we want to know when to hold them, when to fold them, when to walk away, and when to run. Now, you might think it's kind of unusual that I pick that particular song and those lyrics, but believe it or not, most of your hedge fund managers are card sharks. When they were in high school and college, they played poker, and through playing poker, they learned those same values. How to predetermine. They don't play poker by the seat of the pants, and they don't invest their money by the seat of the pants. They work out all algorithms that tell them when they should buy a stock, when they should sell a stock, when they should keep the stock. And so they've learned to be very disciplined and have predetermined parameters that they're going to use, not just, oh my gosh, how do I feel today? The market's bad, I think I'll sell everything. No, they don't do that. They put predetermined losses, gains, and they get out and out of the market when their algorithms tell them to.
So today would be a perfect example. Is they have a plan and they don't let their emotions get in the way. They have this discipline of the plan based on either a percentage value or some metrics that says, hey, this is, this stock has now reversed in trend or something to that fact. So I think today is a really good example of how having a plan and that discipline, as you mentioned, with these long-term investors, institutional investors, how they kind of manage portfolios, right?
Right. In other words, you just because you have some money doesn't mean you need to buy something. You can use Warren Buffett as a very good example. He's sitting on a really big pile of cash because he hasn't found something that meets his algorithm criteria as to what I want to add to my portfolio. So he'd rather sit in the cash than invest it in something that really doesn't fit his style.
So what are the other, besides, I want to just, kind of go through stock selection quickly, but because I do want to get to the risk management. So, I know you talk about this in terms of a stock selection, and this is kind of a formula that our institutional traders use. This what you call, what is it, pre-CDB?
Yeah, they basically they're looking at it and saying, what criteria, what is the rate of return I'm looking for? And some of them, of course, some of them are in a particular industry. So they're looking at new stocks coming into that industry, new investing opportunities. But, the old saying that your grandmother probably said, just because you got $5 burning a hole in your pocket doesn't mean you need to go spend it. So sometimes you just, till you get exactly what you want, you wait till it meets that criteria.
Patience is a virtue when it comes to investing, right?
That is. And what we're really looking at when we're talking about portfolio management is risk management. And if you've ever taken a course in risk management, there's really 4 factors in risk management. One is you accept the risk. The other is you avoid the risk, you mitigate the risk, or you insure the risk. Those are the things that you look at. And believe it or not, most people avoid the risk. By that, I mean, they say, gee, the stock market is too risky, so I'm going to avoid the risk. And so they buy CDs, they buy fixed annuities, they call their broker up and say, make me a bond ladder of either corporate bonds or municipal bonds or government bonds. So the credit market, the risk avoidance market, is actually much, much larger than the equity market that we're in. So I'm hopefully most of our audience aren't those people that avoid the risk and just invest only in bonds or some fixed rate.
There's a good point though too. Also, I think in terms of a individual investor, there's also a psychology that says that they will avoid taking a loss because they don't want to accept that they've had a loss too. So there's a psychological aspect of risk management of avoidance as well too, right?
There is. And once really what we're looking at when we're talking about portfolio management is mitigating or insuring our risk. And we can do that through three methods that are commonly used. And that is when we look at our stocks, we can put in stop losses, and we'll talk about that in a moment. We can diversify our portfolio. Those are two ways to mitigate the loss. And then the third way, of course, is to buy insurance. We can buy options for whatever length of time we need. And so that's a way to insure your risk. Now, I'm going to use a personal example here, and that is that I'm older and I'm in the distribution phase of my investment career. When we first started out investing, we were taught, boy, dollar cost averaging is my best friend. As long as I keep throwing money at the market week after week, month after month, year after year, dollar cost averaging is going to really let me make a profit because I'm going to buy more shares when the market is low, and I'm going to buy fewer shares when the market's high. But guess what happens when you're older and you're distributing that? Actually, the inverse is true. You're going to be taking out, if you're taking out, say, $100,000 a year out of your portfolio to live on, and you're doing that fixed amount every month, when the market is low, you're going to be taking out a higher percentage of your portfolio. And when the market is high, you're going to be taking out a lower. And that's why you can't just look at a stock's return over the last 10 years. We have that thing called Monte Carlo simulations that actually goes through those periods and says what happens. And it lowers you from 100% down to a much lower a percentage that you might get a return.
So
Now,
let me ask you a question, Jim. Sorry. So you're in the distribution, right? This time that you're going to be taking money out. So you want to get, I think what the point is that you want to get a rate of return on the rest of your portfolio that is going to help supplant how much you're going to take out of your portfolio. Is that correct?
Right.
Okay.
Right. In
So
other words,
let me ask you though this. How would you, or what would you tell a person that is in the accumulation phase? Let's say somebody is like, they're in their late 20s or 30s or 40s, a time when they're, their maximum growth in their, in their career, or the extra money that they have to put into investment. Now you said dollar average cost. But what other factors would you say would be really important for somebody who's in the accumulation phase?
Normally, if a person's working and in the accumulation phase, I'd say there's sort of a three-tier program you'd go into. One is your 401k or profit sharing at work, because somebody else is adding more money to it with you. So if your company's adding 1 for 1 or 2 for 1 or matching you 50%, that's a good deal. You're actually getting more dollars. Somebody else is helping contribute to your portfolio. So I'd say maximize your 401k, and then once you maximize that, if you've got more money to invest, then look at other deferred things like your own IRA where it's deferred. And then third, of course, is if you've gone to your maximum amount that you're putting in your 401k, maximum amount that you can do an IRA, then you'd buy one of the broad-based indexed funds that you're going to basically leave there and put the money in there, the S&P 500, the triple Q, something like that. So you've got that pyramid, but the most money where somebody's going to match it and it's deferred. Then the second is where nobody's matching it, but the government's letting you do a deduction, hopefully, or you're using a Roth IRA and just making sure that you put that money in. And then the last is some type of an indexed accumulation.
A passive
That's
investment.
sort of the way to go. Yeah.
Okay, great. I didn't mean to interrupt you there, buddy.
No. Now, to give you a personal thing, like I'm in the distribution phase, and so I treat my portfolio kind of like I would a stock that's giving me a dividend. So I'm taking out a 6% dividend every year. So I want to make sure that I can meet that 6% dividend. Plus, I want to go and keep up with inflation. So I look at a 6% dividend, and I use an overall, I'd like to see a 6% growth in my portfolio. So really, my goal is for my portfolio to get a 12% return over time. So that 12% return, so that's what I'm looking at. I want a 12% return. So I'm looking for stocks that I feel are going to give me a 12% return. The next thing I look at is I have the opportunity, of course, in my retirement funds to just ride the market out and put it in the S&P 500 and the triple Q. So I want to make sure I'm at least beating the triple Q in the S&P 500. Now, another thing is, just if the S&P 500 drops 20% and my portfolio only drops 10%, I'm still out 10%. So that isn't, to me, a good deal. So it's got to be, I'm making 12% and I'm beating the S&P 500. And frankly, if the tide is against me and I don't find stocks that can beat the market, I don't mind sitting out waiting for the market to return, because it always will. Historically, we really have 70% of the time we have an up market and 30% of the time we have a down market. So I don't mind sitting it out and taking my profits in that portion of the stock market cycle that I'm having a positive rate of return.
So trends are friend as well, right? You want to try to find those stocks that are trendy.
And the important thing we'll go on later in this seminar is to look at, how long is a trend? Each of us has a different trend. Some of us, have the attention span of a gnat, and we're going to be a day trader. And so if something goes up or down in an hour, we're going to be in and out, where others are going to look at it and say, well, I'm going to do this on a daily average or a weekly average or a monthly average, or maybe even a yearly average. So we'll look at ways that Barchart has some tools to help you figure out how long is the trend that you want to have be for your portfolio.
And then that's where Barchart comes in handy, where you say we can look at trends over multiple timeframes through our Barchart opinion.
Right.
And then we can also think about some Barchart type trading strategies that also might help us in our portfolio management. And then some other tools would be custom views and chart templates. So let's get all to that, right? So we kind of gave this introduction of risk management and portfolio management, and kind of can take us through your process. So let me do this. Whoop, there we go. All right, so I brought up the Barchart page, and so before we started, I think Jim asked me to create a watch list that he thought would be good for demonstrating. Now, before we get to that watch list, I do want to show you folks that we just rolled out some new charts. We have new interactive charts, and also we have some new flip charts as well, beta flip charts. So basically, these new charts, if I'm going to highlight some of the features that are there, first of all, you'll be able to access your chart settings a lot easier. And also, we've added 2 new studies for our premier members. And some of the other things is there is a percentage chart. You can also have a greater flexibility on your time frames, which I think we're going to look at, and also those frequencies, those time frames. Okay, so those are some of the cool features that we'll look at. So let's go through your process, Jim, here. So we have this pretend portfolio, and how do we kind of manage this?
All right. John, can you, on your main view tab there, can you click down to the one that I use? Yeah,
So just let
there we
me
go.
also talk about this. We do have a slide that is attached to today's webinar, which has these inputs that Jim uses in this custom view. So don't worry. Yes, it is available, and I'll show you that later in our process. Okay, Jim, sorry, go ahead.
Now, what this allows, these are the, don't think just because this is what I use that this is what you should use. You should find what you're looking for in a stock. Now, what I look for is, and it's sort of, the time schedule goes from the left to the right. So the first column, of course, is the stocks, and then the first active column is the percentage of change today. Okay, so I can look at that's today. Then the next column is the trend spotter, which is one of the bar chart, or trend seeker, we call it now, one of the bar chart functions, which is a kind of a little black box thing where they take a bunch of deals, sharp ratios and that, and basically on a short-term basis tell you whether this is a buy, sell, or a hold stock. And that's a short term. Normally it's more than 50 days. The next column is the bar chart opinion, and that is 12 different moving averages that bar chart uses, and it gives weight to the shorter moving averages, to the longer moving averages, yet less weight. So that's a good tool. Then the third one is the, what I call the golden cross, which is the 50, 200-day moving average coincident divergence oscillator, which is the golden cross. The next column is the weighted alpha. Now, the weighted alpha is, again, for a 1 year period, how much has the stock gone up with its current momentum, weighted heavier than its
Past performance.
the current one rather than past. And you will see a difference between far out to the right, we have the 52-day moving average, and sometimes you'll see a difference. Now, let's just look at what that means. Right now, if you see where John's got the cursor, in the past year, it's moved up. The S&P 500 index has moved up 19.86%. But look at the weighted alpha is 21.21, which tells me that the current momentum is exceeding the straight momentum for the year. So that's kind of a thing that I look at is it rising faster now than it has during the arithmetic year as opposed to the weighted year. The next column is the number of new highs it's hit in the last month. That's really where I can see which stock is moving to me the most in that year. The next, the 52 percentage high, that is an indicator as to how far it is from the last high it's hit. So that sort of tells me when it's going to hit a new high. Then, of course, we've got the 5-day change, the 1 month change, and the the 3-month change. Now, what I'd like to show you is how easy it is to manipulate it. Suppose I want to know which stock do I think has the best current momentum when I factor it over the year. John, go back to that weighted alpha column and click on that. And you see that it's done now in weighted alpha order. So it's telling me that NVIDIA has a weighted alpha of 161. Now, if we go back over there to the 52-week high, we can see that, hey, it's one percentage point below it, but it shows that, hey, this stock seems to really have current momentum. The other thing is now I can go ahead and click on the 1 month high. And now it's showing me that the stock that's hit the most, Ares Management, which is a private equity firm, is the closest to its week high. Then I can go, what the one that I really love to follow most is the bar chart opinion. Let's click on that. All right, now it shows me Aries has the best. In other words, all those 13 indicators that we're going to be looking at in a few minutes, all those 13 indicators are saying buy. Now look at the bottom. Let's just, John, just click to make it in inverse order. Now look at that, Virgin Galactica. Everybody knows that. That's Bronson's space flight thing. Has 100. All 13 of the indicators are telling you to buy. Now what's interesting is, and this is what this is what I find interesting about Barchart and what I really look at. Green means go, red means stop. So, and we put that in there. So look at all the way across that Virgin Galactica. What do we see? We see the change currently is down, the sell is down, the opinion's down, the golden cross is down, the alpha's down. It's only hit 2 days during the month did it go up. Everything is down. And what happens, John? Click on the opinion, go in the opposite direction. Guess what? We can look across there and we see for Aries Capital Management, we mainly see all green. Today it's down, but look at it. For all the 12 indicators are up. It's up for the last 5 days. It's up for the month. It's up for the quarter. It's up for the year. So I love that part about Barchart. Just green means go, red means stop. And that's sort of how I look at these portfolios. Now, John, you ready to go to the flip chart?
Yeah, let's do that. Let's check that out.
Okay. Now,
so let me just stop here, Jim. So what we've added here is we've added a couple of Jim's templates on our bar chart page. And if you haven't been using them, I would recommend that you at least check them out. So in the settings here, up here where it says templates, you can come and you can find my
Let's
templates.
Go to the first one though, John. Let's go down one to the one I use for bar chart of the day.
The chart of the day. So I just want to show folks under bar chart templates, some of the templates we're going to demonstrate are found in here. So here is the chart of the day template, and later we're going to look at, let me see if I can get, there it is, Jim's long-term stop template. So let's look at the chart of the day first.
Now this is a very easy chart. Basically, it's nothing more than the price, the trend seeker, the 20, 50, 100, and 200-day moving average. And as you can see, Aries Capital Management is above all of those moving averages, and also has a trend seeker buy signal, which is green. Trend seeker in the charts, if the trend seeker is above in red, that means that the stock is a sell. If it's green underneath, it has support and it's going up. And then if you look like right almost halfway in the middle of the chart, you see where it's green and red. That means it's a hold, that we don't know which way it's going to be moving in the future. It's a hold. But here you can see we've got a pretty good line on the 100-day moving average and the 200-day moving average. So this is a stock that we'd like to hold. Now, John, go all the way there and click on the Virgin Galactica. Very easy to see with this chart that it's going down. It's trading below all its moving averages. Not only that, but look at the trend seekers. See the red dots? So the trend seekers telling us, hey, we need to be out of this stock also. So this is a chart that I use that this is sort of my buy chart. This says to this, if I see this chart, I'm not going to buy this and add this to my portfolio, but you can see while I add the other one. Now, John, let's go to the next template, which was the trend. Let's see. You got it there.
Not my templates, your template. The stop one, right?
Right.
And that would be this one. And this one,
okay,
for folks, Jim was going to tell you, has 3 components to it as well, right?
Right. Now, what this has is it's the 50-day moving average
which is
with
this blue line.
the 50-day turtle channel, which means that the top line is the highest the stock has traded in the last 50 days. The bottom line is the lowest it's traded in the last 50 days. Now, what I'm looking for is I'm wanting the stocks that are hitting new highs. And you can see the trend seeker is also in here, and we've seen it go down. Now, notice that this particular one is a daily chart. For you people that want a longer term, John just changed that daily to a weekly. And we've got a chart that's really over the last 3 years. And you can see for even the last 3-year period, this has not been a good stock. It's been going down, down, down. It's got lower highs and lower lows. And plus, look at that the price it's been trading below its moving average. So that this can be used back and forth to whether you're a short-term trader or a long-term trader. Now, the third one that we probably want to look at, John, is the Golden Cross, just for those people, since it is probably the most popular chart that is used nationwide, the Golden Cross, or the 50-day, and we can see the same thing on a daily basis. Look at this Virgin Galactica and see that the Golden Cross is telling you to do that it's the price is below the average, the 50-day average is below the 200-day average, and the two are going down. Now, let's go.
Moving average is not a good sign for a stock.
Not a good
One
sign.
of the things I was
Now,
taught.
John, go ahead and hit that Aries. Go back to the left and hit the Aries, and we'll look at the same chart. Now you can see that here we are with the same chart, the Golden Cross, the two lines, the 50-day and the 200-day are going up. You can see back there when they crossed back in May of, that is the time that under the people that believe in the Golden Cross, they say, that's the time I want to get in that stock. Then I want to buy it there, and I'm going to ride it up as long as those two lines go. When they converge again, going the opposite direction, then I'm going to get out of it. So that's a sort of a long-term one. Now, John, try the turtle channel for this particular.
Look at the templates and how you kind of assess either those stocks that are already in your portfolio, but then also those clues that you're going to start looking at, or that cluster of evidence you're going to start looking at that says, hey, maybe this stock is not a stock that I want to have in my portfolio. We looked at Barchart opinion, we looked at weighted alphas. If we start seeing negative weighted alphas, so kind of walk us through this next.
Can we do one more thing? Can we just click on the
some of these stocks in your portfolio?
Can we just click on the turtle channel for this stock?
Nope, you don't. Not that one.
Started, yeah.
Nope, this one. There we go.
Okay, and we can see same thing. What I'm looking at for Aries management, and this is the daily chart. It's been going ahead, and we are getting new highs, and we are getting higher lows. If John, if you can just click on the long term, the weekly. For those people that like the longer term, and we can see here's over a longer period of time, really over a 3-year period, we can see that this stock has been steadily going up. And look at that lower chart. We're getting the support. Look at the green dots. Trend Seeker says it, just another way to look at it. So you've got, really, we've looked at 4 different charts that we can go ahead and look at those and get for those that are visual, this is the way to go.
So let's talk about how do we prune, or when do we start making that decision that using the charts, using these different templates, what are you going to look for that's going to tell you that maybe I want to be exit this particular stock? And
okay,
while we're doing this, let's kind of talk about this this concept of stops. I know that you believe that there are some value in stops, but there also are some disadvantages. And I know that from past discussions with you that we both believe that there's something called a hard stop, which is kind of where we want to protect ourselves from black swan events. But there might be a selling point, which we might call a soft stop. So kind of walk us through that.
Right. So a hard stop is what is the maximum tolerance for pain I have on a stock? That black swan event that happens while I'm on vacation. Today's probably a good example. That black swan event that happened today, and really right now it's hard to figure out what the position, why we're having it. But the lower part of this chart, this is just one where I would put in my hard stop at that red line, because that's showing me where the stock has the support of it. Now, my sell point may be that blue line. So the hard stop is when I'm away and I'm not looking at my portfolio. But then that blue line is pretty much going to tell me when I should sell. When it drops through there, then I'm looking at selling it. And again, I'm going back to that criteria I had. Is the stock giving me a 12% return on the portfolio? And am I beating the S&P 500 and that? John, can we go back to the custom view? Now, let's look at this. And on the left-hand side, let's the symbols. Let's look at, go down there to where we have the S&P 500 index, the SPSS. Okay. Now, what I should have done before that, John, I'm sorry, click the weighted alpha first. Okay, now I've got my stocks in descending order. Now, John, you've got that, see that bar that John's got? That means that all the stocks above that are beating my S&P 500. All the stocks go up to the NASDAQ. All the stocks above that are beating the NASDAQ 100. So that basically says I'm going to be looking at the stocks that are below and considering whether or not I'm going to get rid of them. Now, what I'd be looking at, see that the Carlyle Secure Fund, not only is it giving me an 18% return, but look at the dividend. It's also given me a 10% dividend. So that's actually a 28% return. I'm going to probably be keeping that. Come down here to Salesforce. Salesforce is now, not only is it 6%, 6, which is below my 12, look at my opinion. My opinion says I ought to sell it too. And so I'm looking at all across there, and that would say that's the stock that I'm pretty much probably going to prune out of there. And of course, we look at the bottom of that Virgin Galactica. Today, I'd be pruning those two stocks out of my portfolio because they're no longer meeting that predetermined criteria I have of a 12% return plus beating the S&P 500 and the triple Q.
Okay, so we're looking at the weighted alpha of the indexes. One of your criteria is I got to beat the index. So now a stock is falling below that alpha, right? It's not creating alpha for your portfolio. Now we have these templates.
It was creating alpha, but not the alpha that I'm looking for. Salesforce wasn't creating the alpha that I wanted, but it was creating alpha, say 6.11.
So how long, again, I guess this is more about, again, the difference between a short-term trader and a long-term investor. How long do you allow a stock to underperform the index before you prune it from your portfolio? Is it a set amount of time, or do we go back to, let's say, those custom templates and say, well, I might give the stock a break, but if it breaks like the trend spotter, or it breaks the 50-day moving average, or it makes a new 50-day low, then the combination of underperforming and that signal is where I'm going to exit the trade.
All right. What then I'd look for on that one, let's look at the 5-day change for that column, the Salesforce. Let's go across the line on Salesforce and see, okay, in the last week, the 5-day change last week, it's down. In the last quarter, it's down. So I'd say there it goes. Last quarter, it's not beat. Not only has it not given me positive alpha in the last quarter, it's not beaten those two indexes that I want to beat. So strike three. Not beating the first
Is
index.
it also, could it be a percentage, let's say, from the 52-week high? For instance, I short on this in terms of the largest loss. I mean, we've already saw Virgin Atlantic. We know that is a dead dog. But here's Salesforce is down 21% from its 52-week high. Is it, that's kind of, bear market territory, right? Is that kind of your process as well? And why we're looking at this, I'm going to listen to what you're saying, but I want to go back to the flip chart and look at this stock in terms of Salesforce, in terms of, your turtle channel templates, and so kind of maybe walk us through, those signals that you're going to look at, that timeline signal.
See the way it dropped off there? The lowest low dropped way down right there. That almost coincides there with that 3 months. That's where you'd want to say, boy, let's get out of that stock. So it's a combination of looking at those. First, I take everything and put it in that weighted alpha section. Then I go through the flip charts, and it's very easy to see when I want to get out of a stock. Now, it's funny that you mentioned that, John, that how far it is from its 52-week moving average. Go back to there and look at the one that was right below it, Tesla. Okay, when you put it in there, look at Tesla. Now, click on Tesla's chart. We see a totally different thing. So this is where the chart kind of backs it up. If I'd gone ahead and taken that one indicator of how far is it from its 52-week high and said, hey, these are two ones that are over 20%, I'd want to get out of that stock. But you can see that when I actually look at the chart, this Tesla looks nothing like that Salesforce looked like.
So let's go back to Tesla for a second. Now, these two red lines here are channels, but Jim, let me just ask you something here.
Sure.
So is there a red flag now on Tesla? Is because, first of all, let's say alpha starts to dip below the S&P or let's say the Qs, because this is more of a technology stock. Now we're getting our trend spotter has turned from green to red. We're in the range. That's kind of our hold. But we're still above the 50-day moving average.
It's turned from green to hold. Because if you look, there's a dot below and a dot above.
Right.
So it's at a hold right now, which says, which way is that stock going to move the next week?
So this would be in the I will watch list. In other words, I might make a decision to trim this from my portfolio, but I need other evidence. And what would that evidence be? A close below the 52-week or a close below?
I'd take my stop loss and move it to the 50-day moving average.
So you would move it from the low down here, which maybe was down here. Now you're going to move it up to the 50-day moving average.
That's right. Then I moved it and said, well, because what's going to happen is when it goes below that 50-day moving average, then the trend spotter or trend seeker is definitely going to give a sell signal. But if I'm, this is the time when I'm looking at a stock saying, I have no idea, it does not have a trend. And you can see it does not have a trend right now. Over the last week, it's been pretty much trading in a range, not going to any increases. That last increase was over, 6 trading days ago? 1, 2, 3, 4, 7 trading days ago. The little dimple, that's the other thing that Barchart does for me, is it puts a little dimple above the 52-week high. I mean, the previous highs. So see that little dimple tells me I can look at that and say, hey, there's the high point of the stock, and it's been trading the last week or so. Also a dimple on the bottom. There was the low spot that it picked and gives me that dimple. So those are two good indicators. So this would be a stock I'd monitor. But I think you can see the difference in the chart between the Salesforce and this chart if I only looked at how far away from the 52-week high is it.
Right. You wouldn't throw the baby out with the bathwater. You still need other information. But if we go back to the Salesforce, certainly the evidence has been mounting, right? We went from a hold, we broke below the 50-day moving average, and we also, before this big sell-off, we actually did get below, your turtle channel. So all those things would have been permission for you to, at any point in time, said, hey, maybe this stock is not performing, alpha's not performing, but maybe you still want to hold on to the stock. And this is where options come into effect, right? We could buy.
So
I'm not going to
Friday,
buy an option, a put option to protect myself all the time because
no.
there's a disadvantage to that, and we'll talk about that in a second. But now the evidence is saying, hey, I'm now below my 50-day moving average. My trend seeker is now showing me, red, not green. So now maybe it's the time to buy insurance. Would you agree with me on that?
So I'll go ahead and just summarize a little bit here. What I like to do is every Friday, I go to my custom view and I click on that weighted alpha and I put the stocks in that order so I can look at them. Then I go through those and click through those 4 custom charts. And after I've done that, I can pretty well tell which stocks I'm going to keep and which ones I'm going to go through. That's sort of the way I do it. Every Friday after the market closes, like I say, I short using the custom view, and then I go through the charts and want to look at the bottom stocks. So sometimes I'll do it in the inverse order so that I'm only looking at the 1 or 2 stocks that I'm really wanting to bail out of that week or thinking about bailing out of.
We got a really good question from Marianne. Let's just answer this question because I think it fits in right what this discussion will be. So Marianne asks, to clarify the red line, blue line for hard and versus soft stops. So what Jim is saying is, for instance, this is a daily chart and we're looking at the 50 channel, the highest price over the last 50 days and the lowest price of the 50 days. So his hard stop might not be at the daily level. It might be at the weekly level, right, Jim? That's kind of your process. So normally, we would use the low of the weekly. But if he's doing
previous
this
calls,
process,
Gene has asked me when I first buy a stock, I put a 15% stop loss in it the day I buy it. And then from then on, I'll be looking at the charts. But I'll buy the stock, immediately put a 15%. That's my maximum tolerance for pain.
So, Marianne, also what Jim is saying is when we talk about alpha, is this stock continuing to add to my portfolio? One way that we can do that, we don't have to look at a statistic like alpha. All I want to see is, is my upper channel continuing to rise? This is a great sign that the stock is doing well. When it goes flat, like a heart patient, that is a sign of concern, right? So going flat, this is not a stop indication or a loss, but it's certainly a level where I say, hey, the momentum of the stock has been lost, and now I need to start looking at some risk management procedures. And what you've learned from Jim is that, yes, we can use the blue line, which is a 50-day moving average, or we can use the bottom of the turtle line channel as a stop. Each trader, each investor has their own risk tolerance. And one of the things I was trying to point out in Jim's assessment is if my stock has fallen 15 or 20% off of its 52-week high, that could be a stock that is in bear territory. And if I come to the chart and I see it's below its 50-day moving average, I see it's on the bottom of the turtle channel, then I need to have some kind of procedure either to trim that from my portfolio or to mitigate and now insure my risk, right, Jim? This is where the timing for,
Right.
put allocation could be a good time.
Let's go back to the Tesla chart, and we'll use that as our example that we're going to go look at. All right, now I'm sitting here looking at my Tesla chart, feeling kind of good about it that Tesla's gone up. So it's Friday afternoon, all right? And I'm looking at the 271's the highest it hit. It's been now closing. Let's just pretend we're closing the market. It's at 243. So I'm going to set a stop loss down there at, let's just say today I'm looking in, again, remember, we hit the high and low. We've got a hold on it. And I've moved my stop loss up to that 50-day, 50-period moving average to 202. All right. Friday afternoon, I've got a stop loss at 202, and market closes 5:30 after the market closes. Elon Musk corporate jet goes down in flames. No survivors. Where do you think that stock is going to open up on Monday?
A lot lower.
It's probably going to be open up below my stop loss. So my stop loss is going to kick in on Monday morning when the market opens. My stop loss is going to kick in as a market order, whatever it's at. And using that example of Elon Musk plane going down over the weekend, I guarantee it's going to open for less than that 202 where my stop loss was. So my stop loss didn't save me. Diversification might have. Suppose I had 10 stocks in my portfolio, so that loss that I'm going to take in
The one stock.
in there is only going to be one stock. 10% of my portfolio went down because of this event. Now, John's going to tell you a way that you can pay a few bucks and make sure that you're able to weather this event out.
Right. So what I would, at this point, if, not looking at today's, today would actually be a great example of it. But if I had seen my stock go sideways for a while, and then now we're starting in that hold position, and the stock starts falling below the 50-day moving average, or that we start seeing that trend seekers more red dots than green dots, that would give me permission to start doing let's say a put campaign. In other words, I'd be looking to buy a put. Maybe I'd be buying a 202 put in this case. And so that would protect me from those black swan events, right? Because then if it opened up, let's say at 167, because I owned a 202 put, I would not lose more than 202. That's the purpose of an option. Now, the problem though is, the expiration, or how much time do I want to pay for? So if you think the event is going to happen, relatively soon, you're going to take an option that has a less time. I think just as a means of looking at the techniques that Jim is telling us, we probably want to look at puts that are outside of 50 days or the lowest price over the last 50 days. So that means 2 months out. But you could buy a put that is 6 months or a year. We could look at leaps. The problem, though, is as we go farther out in time, that we have to pay for that time. And so that would add to our cost. So what we kind of want to do is try to find that balance between how much time I want to protect myself for some kind of event or some kind of market momentum movement, and at what level. And so one of the easiest ways to do it is kind of look at this 50-day moving average and then make sure that my cost, let's say as I go longer out into time, let's say I look at a leap, I go buy insurance for 1 year. I don't want to spend so much that it's going to, not give me any protection, let's say, down to the lower level. So there's a balance there, and that's a difficult balance. And that really comes down to the individual investor, right? How much
and
tolerance
you
for
wouldn't
risk.
buy a put for every single stock you have in your portfolio.
Right.
You'd want to look at it in two times that probably you'd want to look at a put. Number one is when we're looking at this period where we're not sure which way the stock is going to go. It has been going up, but recently it's dropped down. So it's in that hold area. So we might want to buy a short put then. The second time is most of the time the stocks have these major moves during earnings season.
Right.
So we would buy a short put that would get us through this earnings season because, of course, if we feel very good, the stock's been going up and very, very well, but we're not sure. I'll give you a good example. Porsche recently made this press release. It says, we don't know what our earnings are going to be because we're having an aluminum shortage. So we're going to have a hard time building cars, or Tesla says they can't get something. If you see a press release that earnings are coming up and you think the earnings are going to be disappointing, you've got to make one of two decisions. Either you're shooting from the hip and going to sell the stock, or you're going to put in a put so that you say, well, if my hunch is that it's going to have a bad earnings call and it drops 13%. How many stocks, John, do you think have dropped in the past week? The major stocks that have had earnings calls, how many of those do you think have dropped this past week?
Yeah, I mean, I don't know that statistic, but I'm going to guess that it's,
a good
25%.
number that have had bad earnings call have dropped more than 10%. There's been quite a few of them this week.
Yeah, I would say it's probably about 25 to 30% of the, right? I think that's kind of would be a fair number.
Yeah, so that's why I say that this would be a period when I'd be saying, gee, if I'm having these bad earnings calls, maybe I'm going to look at either selling or putting in a few puts.
Right. So this is where kind of we can blend this, is that because I don't really want to buy puts all the time, or I don't want to continue rolling buying the puts, because as I pay for those puts and if the event doesn't happen, then those puts expire worthless, and then that starts to deteriorate from my results from my portfolio, right?
Right. It's getting you through that period that you're having anxieties over. The
Right,
stock's
Jim,
not bad enough to sell, but you've got an anxiety, your gut feeling that something bad may happen, and you want to buy some insurance.
So Jim, let's do this. Let's kind of wrap up because we're getting towards the top of the hour, and I've been trying to answer as many questions. I see a couple questions we've been answering as we've been going along, but I want you to talk about diversification. I know you love this term. You talk about diversification and worsification. What does that mean?
Sure. The London School of Economics did a nice little study. They looked at hedge funds and tried to see what was the ideal number of stocks you ought to hold. But they weren't able to determine it, but they did come into something that is so common sense that I'm surprised it didn't slap right in the face. And that is that the hedge funds that had the fewest number of positions had the highest rate of return. And they came out with something very simple that says, well, it's easier to get 10 good ideas than it is 100 good ideas. So that's it. What is the ideal thing to do? I've got friends that tell me that they don't ever have more than 5 stocks in their portfolio. Now, of course, we've got some little things we do with Motley Fool. We have a thing there, and Motley Fool says you ought to have 25 stocks. So I would say, and when I look at portfolios on Motley Fool that are successful, it tends to be those people that have the lower number, that around that 25 to 15 holdings, that seem to have the better returns. Also, you guys are individual investors. You're not doing this 12 hours a day, 7 days a week. You've got a limited amount of time. So how many stocks do you think you can monitor, manage, keep up with, and manage? Right. So that's why I say that number is somewhere between 5 and 25. I like to do about 10. That's the maximum.
That's awesome, because when I was studying for the CMT, one of the things they talked about portfolio management, they found that somewhere between 9 and 13 stocks helps buffer your portfolio from a single stock event. In other words, one stock that has a black swan event, that buffers it. And then there was also this idea that what you just said is that as your portfolio gets bigger, 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 and bigger, then that also starts to detract from your portfolio.
Now,
right?
on that also, John, remind everybody that we're talking about 10 stocks in 10 different industries. If you've got 10 chip stocks, they tend to move together.
Yeah.
So
Well, that makes
10 auto stocks, they tend to move together. You've got 10 REITs, they're going to move together. You've got 10 utilities, they're going to move together. So we're talking about diversify not only in different stocks, but in different industries.
All right, so it's top of the hour. I do want to end our session, but just briefly, Jim, how important is dividends, and how do you use that or factor that into your analysis?
The dividends are important when I'm looking at total return. For instance, this portfolio we've got up here on the screen, they're not randomly picked. There are, we've got some large cap ETFs, then we've got some private equity, we've got some private credit, we've got some real estate investment. There's 3 real estate investments, but notice that even though there are 3 REITs, they're in different positions. One does single family houses only. The other one does apartment buildings only. The third one does malls only. So, I've got, even though it's in the real estate, I'm diversified in the real estate. So when I'm looking at those, I'm in different industries and different areas. Now, when I look at that Carlyle that's at the top there, notice that it's an 18% alpha, but it's also a dividend of 10. So I'm really looking at 28% return on my money.
Right.
So that's the dividend comes into play when I'm looking at what we call income stocks. And the income stocks are mainly private credit, utilities, REITs. That's when I want to know not only the movement of the price, but what kind of a dividend are they paying.
So here's on our slide. Here's Jim's custom view. These are the inputs. So again, these slides are attached to our webinar today. So if you're interested in those inputs, there they are. And then also, we talked about some of the different aspects of how to create the custom views, but learning what those elements are. So Jim and I did a webinar a little while ago. I think it was over a year or two ago on stock selection. He really goes into that process. So there's a link there. How to create a custom view, how to customize your charts. Now, maybe we need to update that one because we have new charts. Bar chart opinion. I see a question about how do you get bar chart opinion? So there's a webinar on that. And then those trading strategies, those momentum, moving average, crossovers. I also have one in there for the Golden Cross. And you can find those in our Learn section on the website in the archive section. So Jim, listen, I want to thank you again for your time. I find your wisdom just so simple, but so profound. I've actually incorporated some of your techniques in my process. I feel like I'm a little bit of a short-term trader, but I think in terms of my wealth bucket, my long-term investments, over the 2 or 3 years that I've been talking to you, I feel that my performance has gotten a lot of better. So I appreciate everything that you've done for me. Thank you so much, sir. All right, Jim, thanks so much. Anything last parting words before we say goodbye?
No, just remember that discipline's what you got to do. Make up your mind ahead of time what those disciplines are so you're not shooting from the hip. Predetermined algorithms, when I'm going to get in the market, when I'm going to hold them, fold them, when I'm going to walk away, and when I'm going to run.
All right, Jim, thanks so much. So I just want to remind folks that I get in a lot of questions about some of the tools that we have. I just want to let you guys know that, we do offer some free trials for our Plus and Premium services. And one of the main things that you understand is that, like, for instance, a custom view, a free membership, and Gene, you can correct me if I'm wrong, I think you only get one custom view. But if you only had one custom view, certainly probably Jim's would be a good one to start with. But for Plus, I believe it's 10 custom views, and Premiums, you get an unlimited amount of custom views. So just for one feature that is part of Barchart, trying out the different subscriptions. And you can try those out for a 30-day process. So I would give that a shot. Gene, am I forgetting anything? I don't think so.
No, I don't think so. Just talking about the upcoming webinar that you have.
Yeah, next
on
week
gap
we're going to
trading.
do a gap trading one, which is called something I call the end of the road gap. And it's a chart pattern that can show you a potential change in trend. It usually comes in a very quick motion. So here's the cues, and this will be one of the ones that we'll be studying. So I'm going to show you how to trade this as the gap is being developed, but also how you can start building strategies. Again, this would be a great, if I saw one of these gaps, this would be one of those ones where I would start using that put criteria to protect my portfolio if this was a stock or an ETF that I had in my portfolio. So I think you guys are going to enjoy that one. This is kind of a part 2 of one that I did 2 or 3 weeks ago about timing short selling opportunities. This might be more about risk management, but it certainly will show you how to manage a trade based on this type of gap scenario. So look for that one next week. I think you guys are going to enjoy that. Until next time, folks, I appreciate you spending time with us. I hope that you got something benefited out of it. I know that I did. Every time I talk to Jim, I learned something. Until next time, the best of health, manage your risk, and the good of all trading.